Hi guys, welcome to the Savvy Money Show with me, your host Sean. If you find any of today's entertainment helpful, don't forget to smash that lovely like button. If you haven't subscribed already, don't forget to hit that subscribe button and bell notification. You'll be notified when a new video gets uploaded. Today we're going thick and fast, almost as thick as me and a lot faster than me, because we're trying to get as many in as possible. We're going for stocks that are under $10 that we think can go above $10. And we'll start with Nokia. Now, Nokia is one of those that you put in your drawer and forget about until you suddenly see it's risen. Look at that. It's $53 a share. I don't think it will go back there, but I think it will be a player in the 5G market. It will give you a dividend, and I think it'll be worth picking up at this price. It's one of these that will just go along steadily, and then once it hits something as a catalyst, it will jump up. Now we go on to the next one, which is going to be Glue Mobile. If I do this correctly, it's just under $10, but I think you can do a lot better. Now, Glue Mobile has contracts with Atari, Activision, a number of other people. I think it's going to be one of those that has really done well from this lockdown, that has gone under the radar a bit. Some people are buying in, but I think it's still gone to the radar. Now, I have bought into Altria, so I've got something in. Sorry about this. So I've got something in this. So, but Cronus Group, basically, because Altria owns 41% of it. It's taken over another cannabis dispensary group in Canada, and the problem's been the lack of the dispensers in Canada hitting the sales, and I think that will be one for the future. Now, this one, Zinger. Now, I think a lot of us know about it. They do a lot of the mobile gaming apps, and they teamed up with Garth Brooks to do Words with Friends. If only he knew what that would have led to. He actually said that playing Words with Friends would be more important than letters and a text and a call to a friend. If only you know, Garth. If only you know. Nah, I don't do it myself, but it was also featured in a hit comedy show where a certain star was playing it with a certain deceased genius, and they, you can see a peak there that helped peak it up. And now you have to wonder what's next on the horizon. I just think they can carry on growing from here. Now, their revenue has grown 52% since the coronavirus hit, or the Rona for our friends across the pond. The problem with them is they have a low profit margin. I think the CEO can improve the profit margin. If they can, this is going to be a good one. Anyway, the next one is going to be Yamana Gold, AUY, and the reason for this is, you can see there was $20 a share before, but that's not the reason why. If you see, and do your research. And I urge everyone to do their research on these stocks. I'm not a financial advisor, but they have two main gold mines. One of them, they've extended the life to 14.5 years, and the other one, they've found 3 more gold streams than they originally thought would be there. Price of gold has jumped, obviously, so that is obviously, both of those are good things to look into. They pay a dividend. Not all gold mine companies do. They have a $5 billion market cap. And don't forget, it's a Canadian gold company. Canada sold all their gold for dollars. Now, what's going to happen if there is a crash of the if there is a crash of the dollar because of all this printing of money to Canada? Canadian gold is going to be Canada is going to be looking for gold, and this sort of thing is going to go up. Now, I'm going to go to a few others. Now, these aren't going to be as interesting, but I still think they're worth talk. But sorry. Now, BT Group. I spoke about them before. They broke the resistance mark and they've gone down a little bit. I sold when it went to 125, and a lot of my high portion of my shares, and I'm going to buy again. At the moment, I'm averaging 117. I'm going to, because these are going to be the main players in the UK in 5G. They're the main players in the UK when it comes to Wi-Fi of any kind. Also in Europe as well, places like Italy and you should know they've been fined a lot of money from these places for price fixing, but that's all behind them now. I think these will come back. They will come back to at least 150 to 180 levels. They've cut the dividend for the year, and that was the sensible thing to do. I think forget this year with BT, it's next year. You're buying them at a huge half the price for next year. It's a bit like Disney, it's a bit like the cruise stocks and all the others. That's what you're buying them for. Now, on to the next one. Capstone companies. This is very cheap. This is like worse of the penny stocks. Now, I just think that this will have room to grow, and you see that it's starting a bit of an upward trend, but it's whether it can keep it up. Now, you have to look in what they have. They have one second. Let me go here and see. Because it pulled up the wrong thing. Yeah, it's actually a REIT. Now, that's the thing I don't like about Yahoo Finance. Go straight to the US ones. Now, it should be a £1.62. Yeah, it's a £1.62 share. Now, it's a REIT that concentrates solely on Covent Garden estate. It has a retail and dining destination. Now, this has been hit badly at the moment, and it's caused net loss. Now, you can see it, but it has debt to assets of 20%. I think this is worth picking up purely because the upside of it is going to be you can double your money. I wouldn't put too much into it because it's loss making. and it was loss making the quarter before the virus. But I still think it's a prime real estate, and I would consider it a spec play. However, it has been making a loss, so I would only put a minimal amount in it. The next one, CLDT, I spoke about it before. This is a problem with trading 212. They don't have a lot more. Now it has I'm going to the REITs now, but it's Marriott, Hilton brand, and Hampton brand. Now they've been doing badly, obviously, because people aren't staying in hotels, but with the lockdown lifted, it might be worth going. Now another one, Assura, 79 pence. This is a primary care medical. I've spoken about some of these before. PE of 24, dividend of 4, profit margin of 71, debt to assets of 41. Now the thing is, it's not even at its high at the moment. It's near its high, but not at its high. It's a healthcare REIT, a specialist healthcare REIT. It's low price. You're going to get your money back with a REIT. You know you're going to get your money back as long as they're paying out. No, sorry, that's wrong. Right. The next one is going to be CREI. These aren't all REITs, by the way. I'm going through the REITs at the moment. Custodian. Now, these are low. So basically these ones will double their money, but at the same time they should pay out, purely because even though it's got a PE ratio of 12 and it's 8% dividend, the revenues have been increasing, 59% profit margin, 26% debt to assets. Now they have tenants such as Royal Mail, Superdrug, Poundland, Tesco's, Specsavers, WH Smiths. They've all been open during this. Some of them, their tenants haven't, such as day nurseries and things like that, but some of them have, and they have collected more than 60% of their rents. And you've got to remember, with the likes of Royal Mail, it was in the news the other pre-COVID-19 that they sold their land and then rented it back again for 70-year lease for the same amount they sold their land. Just on the books, when it came time to announce their profit, they had that £70 million on their books, even though they gave it back the next month. It was, dodgy accounting, but this is how these people get this land. Not to mention, I think a lot of these companies will have let their leases come near the end, and they'll be paying a premium for their lease to extend it. I think this is going to be a good one. So we now have NRR, New River REIT, and I think this is another good one because it has, it can 4 or 5x once things are back to normal. It gives a 41% dividend yield, and the only reason stopping me from putting more in was pre-COVID-19. Had a bit of a loss. Before then, years before then, they were making profit, no problem. But this is mainly the pub sector that was causing it to take a loss. But they don't just do pubs, they do Gray's Shopping Centre, which is known as Lakeside, Hollywood Retail and Leisure Park, all these leisure parks, and then they do the Stars pubs. Now, the Stars pubs are the side that caused them to make a loss, but I think they will come back, especially after lockdown. People want to go out, they want to have a drink, and sorry, Chatham Lodging. Yeah, I thought I said about them. Yeah, I did. Sorry. Right, now the next one is going to be home building, and it's going to be one I haven't spoke about. Galliford Try. This was actually on Alan Sugar's The Apprentice a few years back. Now you can see here how it was 8 times the value before COVID-19. They build properties, and then they maintain, they renew, they upgrade and manage services. You know, they have a whole array of different things, from wind farms, water, oil, gas, rail, whole loads of different things. P ratio 0.85, dividend yield 30. Now look at that. The profit margin is 3%, which is very low, very tiny, I get, but debt to assets 73%. Now, I wouldn't expect that dividend this year. I wouldn't be buying it for the dividend. I'd be buying it for the growth. They're a home builder, and they're a well-known home builder. They're known for building in affluent areas like London, or the best places of Glasgow, Manchester, Edinburgh, where people want to live. They have deals with the councils, with everywhere. I mean, there's a place around the corner. I contacted the council and asked, is there any chance how I could purchase the land? And you have their, they've moved out. GP services have moved out. It's lying empty. And they've gone, no, we're no longer using it, and then all of a sudden the lease made into a mosque, and then all of a sudden, next thing you know, they've got rid of the mosque and they've sold it on to someone like them, Galliford Try, who have knocked it down and are putting up high-rise flats. They maximise their profit and they do a good job. Now, I think it's a good one to have, but you have to do your own research, because such a small profit margin, you see here, top recovery by, the problem is it did have problems where a couple of years ago overstated its net assets, but where they were pulled up on that, they won't do that again because they're worried about getting fined again, and that was a couple of years ago. Now it's trading way discount. Now 5 months ago it was a 40% discount. Now it's a bigger discount because people don't trust the earnings. They don't trust the figures because they fudged the figures before. Now what happens is when they sell a company, when they sell a tower block, they do well. When they don't, it costs them money. Now, I hope you enjoyed today's show. There was a lot of stocks there. Let me know if you're interested in going into any of them, or you own them, or if there's any you think I missed. And I'll see you in the next show. See you later.